Hello traders. In this video, we will cover a full course on smart money trading, from a starter level to an advanced level. By the end of the video, you should be able to have enough knowledge to slowly become profitable, of course with patience and practice. So without making the introduction longer, let's get started. The first chapter is market structure. The market has three types of movements. The uptrend. The uptrend is the price structure that repeatedly breaks highs and maintains the price above the last lows. The uptrend is confirmed once price first goes up, then retraces back, breaks the previous high while not breaking the previous low, and this process usually repeats until a reversal pattern that we're going to talk about soon. So the price again retraces, doesn't break the last low, so the pullback ends above the last low, then price breaks the past high, and so on. This was a representation on how high time frame price action looks like on an uptrend, but usually the market structure is not that easy. You will more often see price look somewhat like this. So the uptrend starts by a price movement to the upside, then a pullback. Notice how the price structure looks different than the structure from the last representation. But the direction is the same. The reason is that the pullback from the uptrend is actually a low time frame downtrend that turns into a reversal into an uptrend. Basically, the end of the pullback is where both time frames. So the high time frame and low time frame align and move in the same direction. Then the uptrend confirms after the time frames align and price breaks the last high. And essentially the same type of high time frame price action repeats until a reversal. The low time frame downtrend in the high time frame uptrend. So we are talking about the pullback. It will likely look different since obviously price reflects the buy and sell orders that are executed so fast, especially on liquid markets like forex and the stock market. But the direction is the same. We will shortly cover why price action differs but has the same direction, and it's all related to liquidity. The second type of market movement is the downtrend, oppositely to the uptrend. The downtrend is a market structure movement that repeatedly breaks the past lows while holding the price below the last high. This movement is often characterized by a lower low and lower high. So the high time frame trend is a downtrend. Then the pullback on a downtrend is to the upside, meaning that this pullback is a low time frame uptrend that reverse and align with the high time frame trend once the pullback ends and practically after it dumps down and breaks the past lows. This is the simplest explanation and representation of the downtrend. Now let's learn how price action actually looks like on a more complex example. So in a downtrend, the price action starts by a downside movement, then a low time frame uptrend on the pullback, and then a break of the lows. This structure repeats. Pullback to the upside, but the upside movement is unable to break highs, then downside movement and break of the lows. The downtrend is a market that favors short sellers over buyers. The third type of market movement is the sideways market. The sideways market is represented by price action that is not trending and is moving towards the same levels. This type of market is often seen right before a trend reversal. For example, you will often see from an uptrend price stops the uptrend characteristics of breaking highs, but it also doesn't break the lows. This price action shows a psychology change in traders. Why does this move happen? For many reasons like buyers closing their positions, buyers not opening more buying positions, but also short sellers aren't that active, so it leaves price moving towards the same highs and lows for a short time period. These sideways market structures usually indicate a reversal. So coming from an uptrend into a sideways market, the price breaks the lows of the sideways market and turn into a downtrend. The sideways market is very hard to properly trade because the movement and order flow is so unclear. There is a good chance you might get trapped in the wrong direction and obviously unwanted large losses in our trading account. So the key word, the secret of this sideways market is to wait for this boring structure to break either side and look for trading opportunities after. Strong and weak levels. A strong level is a price level that price action has shown that it is very hard to break. And a weak level is a price level that price action has shown that it is easy to break. So let's look at the simple uptrend. This is the low of the first movement. On uptrends, we know that lows are not broken. So this is the first strong level. Then price going up, pulling back and breaking the high. So by confirmation of the uptrend, the lowest point of the pullback is the next strong low, and the high that broke is the weak high. And this markup repeats. In the more complex example, it is slightly harder. Upside movement, pullback, and break of the high. Here it is important to know that these are the strong lows, and these are the weak highs. Now in the downtrend, knowing that a downtrend has lows that break and highs that maintain, starting from the simple price action, price going down, pull back up, then breaking the lows. So the strong levels are the levels that don't break, and they are these levels, they are strong highs. And the weak levels are the price levels that do break, and they are these, so they are the weak lows. On a more complex price action, the direction is the same. Downside movement, pull back to the upside, break of the lows. The strong highs are the same, and these are the weak lows. We will get into right now to explain in it more detail. Internal and external levels. The external levels are structural price levels in the high time frame. The internal levels are structural price levels on the lower time frame. Let's take the uptrend scenario first. On the simple structure, it's easy. The external levels are the major highs and lows. There is no internal structure in this example. Same goes for the simple downtrend. The only levels are the external levels, and they are each major high and low. Now let's look into the more complex price action. Upside, pullback, and break to the upside. First, let's identify the external levels. They are same as previous ones, meaning each major high and low. Now into the internal levels. The internal levels are, as we have said, the low time frame structure inside the high time frame. So the internal structure is the price action of the pullback. On the complex downtrend now, the downtrend is identified by an impulsive downside movement, a pullback to the upside, and a break of the lows. The external levels are the major highs and lows. The internal structure is the price action inside the pullback. And in a high time frame downtrend, the pullback is a low time frame uptrend. And these are the internal structures. These internal structures are very important to identify trading opportunities. We will learn all important concepts and put them all together to analyze a chart of fine trading setups. The break of structure. The break of structure is a trading concept used by smart money, used to indicate a continuation of the main trend and a liquidation of the orders that are against the trend, starting from a simple uptrend, price going up, pull back, and then breaks the high. The level that breaks the high is called a break of structure, and essentially it does the same for the upcoming price action as long as the market structure is still bullish, so basically as long as the market is in an uptrend. For simplicity reasons, we can call them bullish breaks of structure when price is in an uptrend. And on a simple downtrend, price goes down, pullbacks to the upside, and breaks the lows. The level that broke the lows is the bearish break of structure, and the concept apply itself for the future price action too, as long as the market structure follows the continuation of the downtrend. We will go into more details on the complex price action after we learn the next concept because these two work together. Change of character. The change of character, also named as market structure shift, is another concept used by smart money that indicates the first signal of a trend reversal. Let's go straight into the examples starting from a simple uptrend price action. Price going up, pull back, and breaks the high. Pull back, breaks the high, pull back, breaks the high. Knowing that the uptrend is characterized by higher highs and higher lows, the change of character begins once the next low breaks the last low. So essentially, the change of character signals a deviation from the initial trend. This is where its name comes from, by price changing how it looks, changing the order flow. We can also name the change of character as a market structure shift. They are essentially the same concept. But it is important to know that the change of character is only the first signal of a reversal. It is not a confirmation, because what it can happen is price just breaking the low and then going straight to the upside, essentially continuing the uptrend. This move is called a liquidity sweep, and we are going to talk about it a bit later. But now let's focus on the actual valid change of character. The confirmation of a trend reversal comes only when price goes up, but is unable to break the past high, and then it goes down by breaking lows. So the price action has printed on the chart the market structure of a downtrend, and more often than not, this validates a reversal from an uptrend into a downtrend. Now for the simple bearish price action, we know that the downtrend structure prints the price going down, then pull back to the upside, and break of the lows, pull back to the upside, break of the lows, and it keeps going. The change of character in the downtrend happens when the price doesn't manage to break the last lows, and it breaks the last high, indicating the first signal that the market could reverse from a downtrend into an uptrend. But be careful, as the change of character is not a confirmation. The confirmation of the trend reversal happens when the price pulls back to the downside, doesn't manage to break the last lows, and it goes up breaking the last high. So essentially, it invalidated the downtrend fundamentals of lower lows and lower highs and validated a market structure shift to an uptrend by creating higher lows and higher highs. Now we will apply both the break of structure and the change of character on the same price action. We will start from the simple structure to the more complex one, which is closer to the action price action, and finally applying all the knowledge to analyze on the charts. So starting from the simplest form of price action. On an uptrend, price going up. Pull back to the downside, which is the higher low, break of the high that marks the higher high, and we apply the bullish break of structure, pull back to the downside, which is a higher low, break of the high being a higher high, and keeps going until the price breaks the past low. It breaks the higher low, which creates a lower high. And this level is the change of character or the market structure shift. Then price goes up, but is unable to break the previous higher high, and it creates a lower high. Then it breaks the previous lows, which are the lower lows, and this level becomes the bearish break of structure. So this is an important confirmation that the market has shifted from an uptrend into a downtrend. So the most likely scenario is that the market will continue the recently created downtrend by price pulling back to the upside, not managing to break the last highs, and it becomes a lower high, and soon after break of the lows. So another bearish break of structure. And price action constantly repeats until the market shows an intention to reverse into an uptrend. And that indication of a shift again into an uptrend is a change of character that breaks the lower high. So it creates a higher high. Then a pullback to the downside that stays above the previous lows. So it created a higher low. So essentially, it printed a market structure of an uptrend. And then the price action should be printing bullish breaks of structure. Now from the downtrend, price going down, pull back to the upside, breaks the lows and prints a bearish break of structure. Pull back to the upside, break of the lows, bearish break of structure, and it keeps going until it breaks the lower high, which creates a higher high, and it maintains above the lower low by creating a higher low. This is change of character. And if price breaks the higher high and still maintains above the last low, it basically confirms the bullish break of structure that has shifted the market trend from a downtrend into an uptrend, and the bullish breaks of structure keep printing until the price breaks the lows, while not being able to break the highs. So it essentially printed a change of character, and the confirmation of the reversal happens when the price pulls back again to the upside, doesn't manage to break the highs, and instead it breaks the lows. So this creates a bearish break of structure, and the market has essentially reversed again. So this is a presentation how a market can shift from a downtrend into an uptrend and into downtrend again. Now into the more complex price action, in which after we will analyze on a candlestick chart, upside pullback, break of the high that marks the following bullish break of structure. Now we enter into the more complex price action, the price pulls back. So remember that the pullback on an uptrend is a downtrend on the lower time frames. So knowing that we can also apply the breaks and shift concept on this price action. For example, here we have a bearish break of structure caused by the low time frame price breaking down the last lows, essentially creating lower lows. Then price pulls back to the upside and stays below the last high, meaning that it created another lower high, then break of the last lows by creating another lower lows, so another bearish break of structure. So what often happens is when price respects the high time frame trend, in this case, an uptrend, the low time frame trend aligns with the high time frame trend and moves into the same direction, which in this case, it's to the upside. This break to the upside is met by a change of character inside the pullback. This type of change of character is named an internal change of character, or an internal market structure shift. So this indicates that the low time frame trend could soon reverse to follow the high time frame trend. The confirmation of the reversal is done by price not being able to break the past low, so by creating a higher low, and breaking the past high by creating a higher high. And this confirms an internal bullish break of structure, in which price follows through the high time frame and continues the macro trend. And from the complex downtrend price action, here we will also apply complex reversals. Price going down and pulls back to the upside. The pullback is a low time frame uptrend with the opposite market structure from the higher time frame price action, so the price forms higher highs and higher lows inside the lower time frame. With internal bullish breaks of structure, this pattern repeats until the price is unable to break the last higher high inside the low time frame, and it goes down breaking the last higher low, which price forms a lower high and lower low. So it forms the fundamental price movement of a downtrend. This changes the character by shifting the internal market trend, and essentially the internal price aligns with the high time frame moving into the direction of the main trend, which is a downtrend, and it breaks the high time frame low. So it created a bearish break of structure on the high time frame, and this price action typically repeats internally. So again, pull back to the upside. Internal higher highs and internal higher lows that forms the internal bullish breaks of structure up until the price can't break the last higher high. And it goes break the last higher low, which creates a lower high and a lower low. This has formed an internal bearish change of character that aligned the low time frame trend with the high time frame trend essentially moving the same way, which is to the downside. So basically, the price action of the first part of the structure repeats itself. That is because the price has yet again changed character into a bearish standpoint. So that means that we have a pullback to the upside, a high that is not able to break the last high, meaning it has set a new lower high, and it breaks the last lower low, setting a new lower low with its own bearish break of structure to the downside. And once again, pullback to the upside, can't break the last high, which sets the price as a new lower high, then breaks the last lower low, and sets a new lower low by breaking down, and leaving another bearish break of structure. And the same process happens on the next one. We can see here that price breaks the last major or external low, which creates a new external bearish break of structure. So it confirms the breakdown of the last external lower low, and it is looking to create a new lower low in the high time frame. So basically the high time frame and low time frame were aligned up until this point, where the market was unable to break the last external low, and enters into a low time frame uptrend by breaking the previous internal lower low, which marks a new internal higher low, and that validates the new internal bullish change of character, from which price action confirms the uptrend by continuing the uptrend price structure. So by creating internal higher highs and internal higher lows with their own internal bullish breaks of structure, and the price goes up to break the last external lower high, and by breaking it, sets a new external higher high with its own external bullish change of character. We have marked with the purple dots every external level, with the blue dots every internal level. The price action from above, so the black lines, is the low time frame price action, and the one below with the orange lines is the high time frame price action. The direction and price is the same in both time frames, only the action and structure we see is different, and the structure is very important for traders to analyze setups. And finally, let's jump into the chart and apply what we have learned. This is the euro-dollar on the daily time frame. The market initially started from an uptrend. If we simplify the price action, this is the upside movement marking a higher high. Then the price pulls back. As we have mentioned before, the pullback is a low time frame downtrend with its own internal bearish breaks of structure. We can't see them the best here because for that we need to move into a lower time frame to observe the low time frame price action on the pullback. For example, switching from the daily chart into the 4-hour chart. But we have the most important part, which is the internal change of character. This structure marks the end of the pullback and validates the formation of the high time frame higher low. This shifts the low time frame structure and aligns the price with the high time frame by going up, breaking the last high time frame higher high, and creating another high time frame higher high. Then we have another pullback, but it breaks the last higher low, which marks a new high time frame lower low, and this is a high time frame change of character. Pay attention and see how price action behaves similarly, like we have explained on the line presentations. So we got the first indication of a market reversal by the uptrend breaking the last low. Remember what we have mentioned before, that the reversal confirmation happens only once the price pulls back to the upside, is unable to break the last highs, and instead it breaks the previous lows, essentially creating the downtrend fundamentals, and those are lower highs and lower lows, it is only now that the downtrend has been validated, and see how price pulls back to the upside again. But the maximum highs are lower than the last maximum highs, and since this market has entered a downtrend, the market could run to break the lows again up until it shows a reversal sign, and the reversal sign that we use is a change of character to the upside. Now that we have learned how the market moves and its structure, it's time to learn the trading entry models. The first one we are going to cover is the supply and demand. Supply and demand zones are price levels or areas where smart money are most actively trading, with the largest volume. So that helps us identify these levels and follow the smart money footsteps. If you look at any financial market, be it stocks, crypto, forex, we should know that the markets move in certain cycles. They go from balance to imbalance, and the then market moves from imbalance towards balance. In other words, the market always chases efficiency, fair pricing, and a fair chance for both buyers and sellers to enter a market. A balanced price looks like this. It moves like a consolidated or ranging market. It essentially shows that buyers had the same strength as the sellers. Therefore, the market creates a choppy price action. The balance must be broken. It's how the nature of the markets is. And this break of balance is called an imbalance. An imbalance in the market is created once the market is pushed aggressively out of balance. This movement is often made by smart money and large institutions with very, very large amounts of money. Remember what we have said before. The market moves towards balance. We can apply this information because from this imbalance, the market will eventually try to rebalance itself. And the rebalance is indicated by two zones that we will talk about. These zones are called supply and demand zones. Let's start with to explain what is the supply. The supply zone is met within two types of price action. One type is the reversal supply zone. This zone is characterized by price going up, creating a ranging movement sideways, and going all the way back down. This whole price action is also often named as a rally, base, drop. The second type of supply is the continuation supply zone. This zone is defined by price action that drops significantly to the downside, then started a slow downtrend and breaks to the downside again. This whole price action is named a drop, base, drop. Now for the demand. We also have two types of price action within the demand zones. One type is the reversal. The reversal is seen by price going down, creating a consolidation or ranging market. Then the price breaks all the way upside. This movement is named as a drop, base, rally. Then the second type of demand is the continuation. The continuation is seen by a significant upside movement, then a slow upside movement, and another significant upside movement. This market movement is named a rally, base, rally. So you should be able to notice how the market is balanced. Then it breaks the balance and becomes an imbalanced or inefficient market, and the market looks to rebalance itself. As we have said before, the balance is when price is moving fair towards both directions. So in simpler terms, once a market is ranging, and an imbalanced market is when the price does not give fair chances to one party, either the buyers or the sellers. Now that we know what demand and supply are, we need to know how to identify them, and how can they be used by traders. The supply is a zone where the market has been balanced, and it suddenly broke the balance to the downside. So this zone is the supply zone. So knowing this sharp move has imbalanced the market, as we have said multiple times before, the market moves towards balance, and we wait for it to happen. This translates to waiting for the price to come back up into the supply zone. This gives traders a sell short opportunity, but under certain conditions that we will soon learn them. Now for the demand zone, it is essentially the opposite way around. The market has been balanced, then breaks the balance by price going to the upside in a very aggressive way. The zone where price has moved before the break is the demand zone. Now that the market is imbalanced, it wants to move towards balance. That translates into price moving back down to the demand zone. This gives traders a buying opportunity. We will soon see how to filter the moves in such a way we can identify high-quality zones. But for now, let's present how to identify the supply and demand zones using candlesticks. Finding and using these supply and demand zones is relatively simple, and it is done by following some steps. The first step is to look for a candle or a small series of candles with large volume that breaks the balance by pushing the price aggressively either to the upside or to the downside. In this certain scenario, this move is to the downside. Now that we have identified that candle, we move into the second step, which is to observe the candle previous to the candle that broke the balance. So to make sure we understand, we are talking about the last candle before the price has moved aggressively. So that is this candle. Now that we also identified the candle, we move into the third step, which is to take the high and low of that candle, so the high and low of the candle from the second step, and draw a zone to the right. You can do that by using lines, but the most common it is marked by a rectangle or box. And this rectangle zone is the supply zone. The supply zone is used if eventually price comes back up to rebalance the market. The price has a high probability of rejecting to the downside from the zone, and this gives traders an opportunity to snipe sell short positions. Now for the demand zone. The first step is to find an aggressive move towards to the upside, a move that breaks the market's balance. The second step is to identify the candle before the aggressive move. The third step is to mark the high and low of that candle, and we wait for the market to rebalance, by price eventually going down, and rejecting the zone to the upside, giving traders a setup for a buying opportunity. Now let's look in the charts and actually see what we have learned. The market is ranging, so we are in a balance market. This candle is significantly larger than the previous ones, meaning that this candle had the largest amounts of volume. This price action overall, unfortunately, does not imply usual large movements, so this might not be the best setup. And we will explain later how to find the best possible setups. But until then, the candle before the move is this. So we take the high and low of the candle. And this is the supply zone. What we expect for this market is for it to eventually and slowly come back up to rebalance. Point where the most often met scenario once price hits a supply zone is for it to reject to the downside and break the lows. So it finally rebalanced the market, and it met our expectations to reject to the downside. And soon after it also broke the lows, essentially continuing the downtrend. Another example. This is a clear, very aggressive uptrend, in which the market comes back down to rebalance. Then the market prints these two large upside candles. A balance broken to the upside marks a demand zone, and the demand zone is taken from the candle before the large movement. So this red candle, we take the high and low from this candle, and this zone is our demand zone. Our expectations is for price to rebalance itself by going back down into the demand zone, gathering enough liquidity, and then rejecting the demand zone to the upside, essentially breaking the last major high. Since we know this is an uptrend, we look for highs to get broken, and let's see what we get from following the upcoming price. So the price hits the demand zone, moves around for a bit, probably because it hasn't gathered enough liquidity yet. So we need patience. The key point is for price to not break below the demand zone. And soon after these large candles printed on the chart, rejecting the demand zone to the upside, and let's see if they can manage to break the last major high. And yes, they did. So far, we have learned the market structure, which teaches us how and why a market moves a certain way, and supply and demand zones, which are an entry strategy. To understand how high-quality supply and demand zones work, we must understand market structure. The market structure knowledge can be applied into the supply and demand, and this is what we are going to talk about now. So let's take a downtrend, which creates lower highs and lower lows. In downtrends, we look for supply zones, like this one right here. So applying market structure knowledge, we see this as a downtrend with bearish breaks of structure in the high time frame. On the downtrend, we expect a pullback to the upside. And as we have said in the first chapter, the pullback is a low time frame uptrend. So price action creates internal bullish breaks of structure. Knowing we have a supply zone right above, we would expect the pullback to end near the supply zone. So the price rejects down the supply. But pay attention, as most traders would probably just sell short right at the touch. And that can be a viable option. But the highest quality setup is as it follows. After the price hits the supply zone, We wait for the market to break the last low. So essentially, we wait for price to create an internal bearish change of character. We do not place orders yet, as we have said in the first chapter. The change of character is the first big indication of the reversal, but the confirmation of the reversal happens after price pulls again back to the upside. Point where we should be able to recognize that there is another supply zone internally on the lower time frame. Supply zone where smart money places their sell orders, and for price to hit the zone, and continue the confirmed downtrend by breaking structure in the high time frame, essentially making a new high time frame lower low. Now for the demand zones. Considering a high time frame uptrend, so a market structure that goes up, pulls back to the downside, does not break the last lows, and it pushes to break the last high. This bullish break of structure confirms the validity of a demand zone. As we have said before, the demand zone is the last move before an impulsive push to the upside, a price push that breaks the market's balance. And most importantly, it is a valid demand zone because the market has respected the uptrend by making higher highs in the high time frame. After price is pushed out of balance, the market moves to rebalance, and that is done by pulling back to the downside. So essentially creating a low time frame downtrend, with internal bearish breaks of structure. The target of the downtrend is the demand zone, because the demand zone is a rebalance of the market. So what we look for is price hitting the demand zone, having a rejection to the upside, and price breaking the last internal lower high. This move validates the reversal in the lower time frame, which means that the low time frame is soon looking to align with the higher time frame. And this validates another demand zone inside the lower time frame, in which we look for buying opportunities once price pulls back, hits the demand, aligns with the high time frame, and pushes to break structure of the last high in the high time frame, essentially creating a new higher high in the high time frame. Now let's check into the charts. This is the GBP/USD forex pair on the 2-hour time frame. We already marked the zones for you on this chart example. We should be able to quickly and easily notice an uptrend. So let's start the analysis. We see an impulsive upside movement. Remember what we have said in the first minutes of the video. An impulsive upside movement with a large candle signals a potential upcoming uptrend that is currently unconfirmed. The confirmation comes when price pulls back, doesn't break the last lows, and it breaks to the upside. That is what we call a break of structure. And notice we called the E, break of structure. It comes from external break of structure, external meaning high time frame. So after price breaking the highs and setting a high time frame break of structure in an uptrend, we get a confirmation of a valid demand zone. Now we can see that this demand zone has not been hit yet. But there should be no problem. Successful and profitable trading is heavily based on patience and self-control. If a zone is not hit, instead of forcing the trade and going out of your plan, it would be a better idea to have patience for the right setup and respect your plan. The market has another push to the upside, pull back to the downside, marking a higher low, then a higher high by breaking the last high, and setting another external bullish break of structure. Now in this case, we did not have a good enough demand zone to take into consideration. The reason was mainly of this candle taking the previous lows of the demand zone, making it a risky zone to validate. So we just waited for price to keep repeating the uptrend structure by pulling back to the downside after the significant bullish movement. Then a large candle with increased momentum breaks all the recent low time frame lows and highs. So essentially, it created a low time frame or internal change of character. We are soon going into these zones to explain it in more detail. But first, let's continue the high time frame price action analysis. So after creating that trend shift inside the low time frame, it confirms a demand zone, which we can see. This demand zone would give a textbook perfect entry, an immediate bullish reaction right at the touch. Then, as we have explained in the lines presentation, a textbook perfect take profit would be at the last highs, because being in an uptrend, we expect the market constantly have external bullish breaks of structure. We have explained the high time frame charting, but remember from the first minutes this important part. An uptrend has a high time frame up movement, then a pullback. Now remember that in an uptrend, the pullback is actually a low time frame downtrend. So we are now zooming into this whole downside price action. We are moving from the 2-hour time frame into a lower time frame. Let's say the 30-minute. This one is completely fine because it's not very far from the initial high time frame. while being low enough to have a good understanding price action, so notice the downside movement, pull back to the upside, and break of the lows. This marks a bearish internal break of structure. The I from the break of structure stands for internal, and essentially the internal bearish breaks of structure keep printing. The market manages to break a lower high, which marks a higher high, and this movement is a bullish change of character inside the low time frame. The trend shift validates a demand zone. Now, if you wonder why this demand zone is taken from multiple candles, well, the demand zone is taken from the higher time frame. It's taken from one candle in the higher time frame after we have seen the first candle larger than the previous ones. The play and shift between time frames is very important. The price is the same in both time frames. The time frame doesn't change the price, but the price action is different between time frames. The price action shows how the market has moved around a price, and the movement is what helps traders identify good setups. The change of character shifts the trend into a low time frame uptrend, and it basically aligns the low time frame trend with the high time frame by creating internal bullish breaks of structure, up until the price hits the low time frame demand, fills the orders from the smart buyers, reacts very aggressively to the upside, breaking both, another internal break of structure, and breaking the external break of structure. This is the complex demand entry, essentially identifying a high time frame demand zone and executing in the low time frame. More than likely, many smart money traders had their buy orders on the top of the demand zone, with stop loss below the demand zone, and take profit right above the last high time frame external higher high. Why there? Because being in a high time frame uptrend, the expectations of the market's movement is to constantly break highs in the high time frame. Going back into the high time frame and zooming into the low time frame in this zone. So into this pullback, and this is how it looks. Pretty similar to the last one. We know there is a high time frame uptrend by the aggressive upside movement and the pullback printed afterwards. And this is the pullback, which is a low time frame downtrend inside a high time frame uptrend. It works similarly as the last market structure, with internal bearish breaks of structure in the low time frame essentially creating lower lows and lower highs. This structure repeats until the low time frame pushes the price up, breaks the last internal lower high, prints the bullish internal change of character, which validates the demand zone before the push. In this case, we have taken the demand zone only from this time frame and from one candle to make it more simple. But we can even go to a higher or even lower time frame to find an even more quality demand zone. But that is a bit overkill in my opinion. The very complex and advanced concepts are most of the times not worth it, because positives always comes with new negatives. And the negatives of setting a very difficult and complex strategy usually comes with missing a lot of trading opportunities. So anyway, after validating the demand zone, the price slowly trends down, hits the demand zone, gathers liquidity, and pushes the market up. This push can also create a new demand zone, which you can take from the lower or the higher time frame, depending on your preference. The best idea is to not go too far away from the initial time frame where you have made the main analysis on, then the same action as the last one. Low time frame aligns with high time frame and breaks the internal structure, and also the external structure in the high time frame. So it essentially continues the high time frame trend. The next concept also used for trade entries is the fair value gap, often shortened and spelled as FVG. The fair value gap is a concept that explains that large sharp movements makes the market inefficient. The theory is similar to the supply and demand zones, mostly because both breaks the market's price and make it unfair for one side of participants, buyers or sellers. And in the case of the fair value gap, it is the level where the market becomes inefficient. And it is used for trade entry strategies, because once price comes back to fill the inefficiency, you will often see a reaction on these levels. It is important to know that the fair value gap is met more rarely than the supply and demand. Let's look at a downtrend line chart before using the candlestick chart, because it makes it easier to understand. As we know, in an uptrend, the price creates higher high and higher lows. On uptrends, we look for demand zones for the pullback to hit the demand zones and potentially give traders opportunities for buying positions. But the pullback doesn't always just hit the demand zone. Considering the price keeps holding the uptrend, this is where the fair value gap comes in, where the price is pulled back, filled the fair value gap, and continued the uptrend. The traders that have waited for the demand zone to hit have lost the opportunity, while the ones that took from the fair value gap successfully capitalized on this setup. We will soon explain in what situations you can analyze to determine if you would look for the fair value gap or look for the demand zone. But for now, let's also explain it from the downtrend. On a downtrend, the price goes down, pulls back to the upside. Situation where there might be formed supply zones to take the price down and basically continue the downtrend. But the pullback might also end lower than anticipated, and that might be because of a formed fair value gap that filled the inefficiency before hitting the supply zone. And the filling of the inefficiency on a downtrend validates the continuation of the initial macro trend, which is a downtrend. Now we want to identify the fair value gap using candles, and then we jump into the charts. First, we will present it for the uptrend. We want to look at a sequence of 3 candles, where one of them has pushed very aggressively, with a higher momentum than the previous ones. The previous candle should have its high wick lower than the entire body of the large candle. And the third candle, which is the next candle from the larger one, should have the lower wick higher than the whole body of the large candle. Notice how if we mark with a line the high wick of the first candle, with the low wick of the third candle, we get a zone. This is the fair value gap in an uptrend scenario. Notice the inefficiency created, and this area can be used as an entry strategy once price comes back down to fill the zone. And now for the downtrend scenario, the rules are similar. We want to look for a sequence of candles, usually 3 or 4. There must be a large candle with a larger momentum than the previous ones. The candle previous to the larger one should have its lower wick higher than the whole large candle. And the candle next to the large one must have its higher wick lower than the whole body of the large candle. And we take a line or any instrument to mark the low wick from the first candle and the high wick from the third candle. And this is the bearish fair value gap that can give traders an opportunity for sell short orders once price fills the inefficiency. This is the US dollar against the Japanese yen in the 2-hour time frame. From the left of the chart, the market has been in a short-lived uptrend, with only one bullish break of structure before price breaking the swing lows, and essentially changing character into a bearish structure. The change of character validates the presence of the follow bearish fair value gap. This is the first candle. The second candle is the large candle, and the one next to the large one is the third candle. There is a noticeable small price inefficiency, and we mark the zone as we have learned. Keep in mind, we look for the formations of fair value gaps as soon as we can identify them, but we take them into consideration only if the trend or market structure validates the fair value gap. So we should be able to identify the fair value gap soon after it printed on the chart. But in this market structure, the validation comes only after we have a trend change. Because if we are right here, the bearish gap has appeared, but the market is still bullish. For the gap to be the highest quality, we wait for the structure to change character into the same trend that the fair value gap was printed, so into a bearish trend in this case, and we simply wait for the price to fill the inefficiency, then take a sell short position, with the stop loss above the last swing high, and take profit below the last swing low. These targets make sense because on downtrends we do not expect the price to make higher highs. Instead, we expect the market to make lower highs. This was the explanation for the positioning of the stop loss, and for the take profit. On a downtrend, we do not expect the market to make higher lows. Instead, we expect the market to make lower lows, so a break of the last lows. The break of the lows is itself a bearish break of structure. What happens after a push to the downside in a downtrend? A pullback to the upside, and then continuation of the bearish trend by breaking the lows. Then the market gains bullish momentum, and we notice the formation of a bullish fair value gap. This is the first candle, the second candle is the large one, and the third candle is the next one from the larger one. And this zone is the bullish fair value gap. But the problem here is that the market has not validates this fair value gap, because the market was still in a downtrend when the gap has appeared. The bullish change of character. So the trend change from a downtrend into an uptrend has happened after the gap has already filled. So this is a lower quality fair value gap, that in this situation it has worked. We signaled it as a counter trend. Fair value gap, trading against the trend is really difficult. We did not take this trade. Even if the setup has worked, there are countless more opportunities take in the future. Be responsible and avoid taking unwanted risks. Alright, but after we get another large bullish fair value gap, this one is the first candle. The large candle is very visible. And the third candle, what we expect is for the market to come back down, move around this zone, and reverse to the upside, essentially continuing the recently created uptrend by breaking higher highs. Now I have some tips for you. Since this zone is very large, what we can do is to wait for the price to come back down. Switch to a lower time frame. Look for a bullish change of character and a formation of a demand zone or a fair value gap inside the lower time frame. Look for buy order opportunities and follow the price action to take profits on the break of the higher highs. If you noticed, we usually use the higher time frames more often. This one is the Nasdaq futures in the 5-minute time frames. This one is a lower time frame chart, and the reason we do not use lower time frames very often is because of false signals and low quality structures. For example, look at this. These are all fair value gaps. The first one from the lowest point didn't got filled. The second one from above got broken down. The third one also didn't got filled. It's only the fourth fair value gap that got respected. This is the first candle. The second candle is the large one. The third one is the candle next to the large one. And by marking the zones, we see price filled the inefficiency with a wick and reversed to the upside. So this was a valid fair value gap. And even the next one from the above. So the fifth fair value gap did not fill. From 5 fair value gaps, we got only 1 that has worked, 1 that has failed, and 3 that did not fill. And price just continued pushing to the upside. I'm not saying that low time frames inefficiencies do not work. They can work, but they are much harder to analyze and need complex knowledge to filter them out and increase your chances of success as much as possible. But why complicate it so much when you can just have more patience? Switch to a higher time frame and do the analysis there. To give a perspective on using low time frame fair value gaps, we will trade a couple of examples during a backtest. So the market is in a downtrend. The wicks fill all inefficiencies, so basically there is no significant bearish fair value gap present to trade. But there is a bullish fair value gap. Now that is this very risky to take because we are taking buys into a downtrend. Basically, we are trading against the trend. Of course, the trend can reverse, but trying to predict the reversal is very difficult. But since this is a backtest, we will take a buy if the inefficiency gets filled. So we are placing a buy order on the top of the gap. The stop loss below the lows, the take profit above the highs. And this is about a 1 to 2 risk to reward. Not the worst, but not the best. So let's see what the price does. The position was opened, and the trade was a 1. Let's see the continuation of the price action. And by the way, we got a bullish change of character since the market has broken the last high, and we got the pull back, and the break of the highs. So essentially, we are in an uptrend now. There is another fair value gap. Buy orders at the top, stop loss below the lows, and sadly we do not have really good take profit targets, this being a lower risk to reward trade. I will expand the position to at least a 1 to 2 and leave this position for longer. Now there's another fair value gap. Stop loss below the lows, take profit to at least 1 to 2 risk to reward. Let's see if we can get a 1 to 3. We can also place the stop loss below the fair value gap. That could give us a higher risk to reward, but it can come with more stop losses being hit. Keep in mind the past position is still running, so we are in 2 buys at the same time. And both positions hit, take profit. The difference between time frames is quality and hit rate. In low time frames, just as we have traded recently, the hit rate is high, the quality is low, and the risk to reward is low. In high time frames, the hit rate is low, the quality is high, and the risk to reward is high. So in the high time frame, we would need only one or two high-quality setups to gain the same total risk to reward ratio as we would in a low time frame. The last one was a low time frame. Now it's time to also look into a setup on a high time frame to give as example backtesting. So this market is clearly bearish. Looks like it initially was in an uptrend and failed to keep the bullish momentum, making sellers gaining control and taking over this market. Before looking for setups, we need to analyze the market. Right here, for example, we got an ascending trend line with liquidity resting below that, shortly after got taken by breaking the trend line to the downside. The downtrend is easily identified by the bearish breaks of structure. We got one right here, then another one, another break of structure, and one more. So far, the market is pushed to the downside in a very aggressive manner, right until the last visible price action where it looks like bearish momentum is decreasing. The lower wicks also signal a liquidation of orders. The price action so far looks like smart money is preparing something. We are not taking any positions yet as there is no significant confirmation or any kind of relevant enough detail for a setup, so let's play the price action and wait until we can spot an opportunity. Finally, the time for some upside movement. This is a very aggressive upside movement. We should have fair value gaps. But first, make sure to mark the bullish change of character, so we do not forget that the market might reverse into an uptrend. This change of character also validates the presence of a fair value gap. The fair value gap is not this, because we can clearly see the lower wick of the large candle almost covers the body of the previous candle, making the price efficient enough to not be taken into consideration. The actual fair value gap is found here. I will write the zone to make sure we do not get lost in between lines. And we place a buy order on the top of the fair value gap. For the stop loss, we have multiple options, like placing the stop loss below the lows, or placing it below the gap, since this is a higher time frame and the setup quality should be higher. I will place the stop loss below the zone, and we will also have a higher risk to reward ratio, looking for at least a 1 to 3 risk to reward. Good. The position got filled, and notice the immediate reaction to the upside. We are looking for the price to break the highs, so essentially we want the market to create a bullish break of structure since the market has changed character from a bearish standpoint into a bullish one. The trade has hit the take profit, but let's just look if it actually managed to break the highs. And yes, it did. The next concept we are going to cover is the breaker block. A breaker block is an order block that failed to hold and flips into a new order block for the opposite trend. For the sake of simplicity, the order blocks are the supply and demand zones, and this is how it works. In an uptrend, we are going to use a bearish breaker block. Let's explain why. We have the uptrend, price making higher highs and higher lows. The pullback having their demand zones, zones that can be valid or not. If they are valid, we know what happens as we did cover in the first couple minutes of the video. The price breaks the highs and continues the uptrend. But if it fails to hold, so essentially it creates a new lower low. And this is a bearish change of character. Now, we have multiple options to look for setups. So far, we learned that on this situation, we look for a supply zone near the top. And previously, we learned that if there is no significant supply zone, we can look for inefficiencies that create fair value gaps. And both strategies can be used. However, we can also use the breaker blocks. The demand zone got broken, turns into a supply. The new supply is named a bearish breaker block, from which we look for price to reject to the downside once the market hits the zone. And in a downtrend, the market structure creates lower lows and lower highs, with supply zones near the pullbacks. The supply zones hold up until a point where selling momentum decreases, and buyers take control over the market. Situation in which the supply zone can get broken to the upside. So basically it creates a bullish change of character. As we have learned, We can look for the demand zones to take the market higher. We can look for bullish fair value gaps, but we can also look for the bullish breaker block. The broken supply zone flips into a new demand zone, which is called a bullish breaker block, and we look for price to hit it and reject to the upside, essentially continuing the trend that recently has reversed. If you wonder why so many entry strategies, well, you don't need all of them. All you need is understanding the fundamentals. So understanding the market structure and liquidity, and choose only one entry strategy and master it before moving into another one. Some traders even combine the strategies, but that is much more difficult. So by using only one entry strategy, you will miss the trades that don't apply to your strategy. But that is completely fine. As much as you learn, knowledge is pointless without a strong discipline and patience. Let's check some examples on the chart. Starting from the left. This market structure clearly shows a short-term downtrend structure, seen by price creating lower lows with bearish breaks of structure and lower highs. This type of that moves significantly in one side, and then shortly after it recovers all the way back. This type of movement is often seen when liquidity is pooled in large amounts in small price areas, most likely a liquidation of buy orders. So taking the stop losses of the buyers to load up and prepare the orders for smart money to push in the exact opposite side soon after. The buyers observed a loss of sellers' momentum and a gain of buying momentum, seen by this more significant upside movement than the other pullbacks from the left of the chart. So many buyers probably have been thinking by this large up candle that the market should soon reverse to the upside, so they were opening buy orders, just for price to take their stop losses, and liquidated their positions. The very aggressive downside movement, coupled with the fact that the market was in a downtrend at this level, validates the following supply zone. After liquidating the buyers, the market drove up to the supply, and instead of holding the supply and rejecting to the downside, the supply has failed and the market broke above it. Since we cannot really predict what's coming, let's assume that we, as traders that use smart money concepts, have sold short this supply zone, so we have gotten stopped out of the trade with a loss. But with the proper risk management, just like we have shown in the previous examples, where we look for at least 1 to 2 or 1 to 3 risk to reward ratio, this means that a win covers multiple losses. So after getting stopped out, the trend reverses because the market broke the last significant high, essentially changing character into a bullish standpoint. Now we can look for demand zones, or fair value gaps. But on this chapter of the video, we are talking about breaker blocks. Remember from the first minutes of explaining the details about the breaker block, the failed supply turns into a bullish breaker block. So essentially, it becomes like a demand zone, and we can clearly see the price reaction with many wicks that have been bought back to the upside and sellers' momentum decreasing, basically making buyers taking over the trend. Now the market is trying to print a bullish break of structure to the upside, and as we can see, later it did. And the second example for the breaker block, the market was initially on an uptrend, characterized by the bullish breaks of structures and price making higher highs and higher lows. Each swing low becomes closer to the previous swing low, showing exhaustion of buyers and selling pressure, yet the market continues its trajectory by making higher highs. The change of character happened before, but the reversal was not confirmed. We can easily see how the swing lows broke the last one. So the change of character extends for longer, but the reversal confirms only when the market also fails to create new highs. Point where if we choose to learn and use the breaker blocks, we look for the last demand zone to fail by basically breaking down. So as it did, and the failed demand turns into a new supply zone, as we call it a bearish breaker block from which price hits the zone, giving traders an opportunity to analyze if they want to place sell-short orders. The markets fill those orders and rejects the price to the downside. And we came to the end. In this video, we have learned how to read and analyze the market, and as well as the 3 most powerful trading strategies. Understanding the topics discussed should build you a strong knowledge base of smart money concepts. There are a couple more things that we will talk about in a future video, but those are small, complex details that are not really needed in most cases. The most effective way is understanding the market structure and its liquidity, in a way to make you feel confident in analyzing the market, and choose one entry strategy out of the 3 that we have talked about. Combine it with the market structure and master it. Smart money concepts can get pretty complicated. In this video, we shortened it and explained it in a simple way, with proper examples for each of the details learned in the video, in a way that even beginner traders can understand. This work was possible because you guys support us. So if you want to keep up the production of our videos, you can by encouraging us by leaving a like and subscribe to our channel, and leave feedback and questions in the comments. Alright, thank you for watching.